Hi everyone, are you ready for another business cycle? In this video, we will discuss how Bricks for SA Limited receives and dispatches customer orders as well as how they receive payments. This is known as the revenue and receipt cycle. So let's see what selling bricks to the public is all about and what is most important for business, collecting the money for the sale. The revenue and receipt cycle consists of the following steps: receive customer order, authorize sale, warehouse, dispatch, generate invoice, record sale, receipt payment, record receipt, goods returned by customer, and credit management. Please note there are differences in the way product and services companies sell their products. This means there will be plenty of differences in the systems you may encounter in an actual business environment. These differences include how the products are sold. For example, goods can be sold over the counter, over the internet, or over the phone. The type of goods, for example, physical objects are sold as well as non-physical objects, like services. The time it takes to make a sale. For example, sales in construction contracts may take longer to complete than over-the-counter cash sales. There's also the difference in how payments are structured. Some companies may prefer cash to credit, where the company only accepts immediate payment and will not allow a customer to pay for the sale over an extended period. Let's take a look at how the revenue and receipt cycle works within the business. The sales department of Bricks for SA Limited is where step 1 of this cycle, receiving a customer order, takes place. Lindiwe, who is a sales order clerk in the sales department, receives customer orders via the internet or phone. Due to the nature of this business, they do not deal with walk-in customers. A customer order is the customer's instruction as to what goods are required. Lindiwe checks if the customer is an existing or new customer. With a new customer wanting to buy goods, Lindiwe has a few extra steps to follow before she can continue with the order. Lindiwe asks the customer for their details in order to create a customer profile. She then asks the credit department to run a credit check to ensure the customer will be able to pay for the purchase. A credit controller, Peter, in the credit department assesses the customer's credit worthiness by confirming their credit records with a credit bureau. If credit is granted, the credit manager has to authorize it before it is communicated to the sales department. Once credit is authorized and communicated to the sales department, the process will be the same as for an existing customer. Lindiwe receives another phone call from a customer. She checks if she is a new or an existing customer. As it is an existing customer, Lindiwe checks if the customer has credit available so that the current sales will not exceed the customer's credit limit allowed. The customer has credit available and therefore Lindiwe can continue with the order. She asks the customer what she would like to order and checks the system to see if the goods requested are in stock. Everything the customer requested is available. Lindiwe generates a sequentially pre-numbered internal sales order or ISO in duplicate and creates a picking slip based on the ISO. She sends these documents to Rob, the sales manager, for approval. An internal sales order or ISO is a document compiled by the company's own sales order clerk based on the customer order, which records the goods ordered by the customer. It is used for sales authorization and as a basis for creating the picking slip. A picking slip lists all the items which the customer has ordered. It is used to assist the warehouse personnel to pick the goods needed to fill the order from the store so that they can be dispatched to the customer. Do you remember what an objective, a risk, and a control is? Let's refresh your memory. An objective is something that you want to achieve. A risk is something that could go wrong, which will prevent you from achieving your objective. And a control is an action that you take to prevent a risk from occurring. Next, we'll discuss examples of objectives, risks, and controls which are found in this step. 2 examples of objectives are to only take orders from account holders who have sufficient credit available, as well as to record customer orders accurately and to initiate proper action to fill the orders. 3 examples of possible risks include orders accepted from non-account holders, which will result in the company not being able to collect the payment for the goods, which will lead to financial loss. Orders taken from account holders who do not have enough credit available, which may result in the customer not being able to pay for the goods ordered, leading to financial loss. And recording inaccurate orders will result in orders being sent back for correction. This may be viewed as bad customer service and could damage the reputation of the company. The controls to be implemented for these specific examples include not to accept any orders from customers without existing profiles on the company's customer database. Orders should not be accepted from customers who do not have enough credit available, and sales clerks have to confirm all the details of the orders with customers as well as the delivery address of the customer. These are only a few examples. There are many more objectives, risks, and controls that apply here. Can you identify anything else that can go wrong in this step? Which controls would you suggest for these risks? Step 2 in this cycle is where the sale is authorized. We pick up from where Lindiwe sent the ISO and picking slip to Rob for approval. Rob has to confirm the following before he approves the documents. The order is from a valid customer. This is done by checking if the customer has a profile on the business's database, and that the customer will be able to pay for the order. This is done by checking the customer's credit limit on the system. Rob also compares the picking slip to the ISO to ensure that they have been prepared accurately. He then signs the ISO and picking slip as proof of his review and returns the documentation to Lindiwe. Lindiwe keeps a copy of the ISO on file in numerical order. She sends another copy of the ISO to the debtors clerk, Martin, in the finance department. She sends the picking slip to Mary, the warehouse assistant, and the original ISO to the customer. Can you think of objectives, risks, and controls for this step? Let's take a look at some examples. An example of an objective is to ensure that orders are only accepted from customers who are creditworthy. A possible risk is that the company may suffer a loss due to a customer not being able to pay. Some of the controls the business can implement to prevent this risk includes: sales order clerks have to check customers' credit limits before accepting the order. Where the order is from a new customer, credit application procedures must be conducted before the order is filled. Credit controllers have to sign off ISOs before these are sent to the warehouse. And segregation of duties where the sales department does not have access to the customer master file, which means they cannot change customers' details or credit limits on the system. During the third step, warehouse, the warehouse clerk Daniel picks the goods as listed on the picking slip and initials next to each item as it is picked. He then hands the goods to Charles, the warehouse manager, together with the picking slip. Charles checks that the goods match the items on the picking slip and signs the picking slip to show it has been checked. He then hands this back together with the goods to Daniel. Daniel hands the goods to the dispatch clerk Devon together with a copy of the signed picking slip. The original picking slip is kept on file in the warehouse for reference purposes. Examples of objectives for the warehouse step include: to ensure that warehouse personnel only act on authorized orders and complete these on time. To ensure that the correct items are picked, therefore the items picked agrees to the order placed by the customer. And to ensure goods which cannot be picked because they are out of stock are identified and a back order note is created. This could be due to a difference between actual stock and levels on the system. The risks here could include not acting on authorized picking slips, which could result in dissatisfied customers as the order will not be delivered in time. Goods being removed from the warehouse for false orders or theft leading to inventory losses. Incorrect items being picked which can result in dissatisfied customers. And items that are out of stock not being identified on the picking slip and customers not being notified of out of stock items which could result in loss of the sale and customer goodwill. Potential controls for these risks include: order clerks have to check that delivery notes and picking slips match, and these have to be filed numerically. Unmatched picking slips must be followed up to determine whether goods have been picked. Goods should not be allowed to be taken out of the warehouse without signed picking slips. The warehouse manager has to check and sign off on goods picked, and the order clerk has to follow up on back orders regularly. When inventory becomes available, the order clerk should confirm that the customer still requires the goods, and if so, make out an ISO to initiate the sales process. Think about other things that can go wrong in this step. Which controls would you suggest for these risks? The fourth step, dispatch, is where Devin, the dispatch clerk, checks the goods received against the picking slip and signs the picking slip if it's an exact match. He then creates 2 copies of the pre-numbered delivery note based on the picking slip and the actual goods. A delivery note details the date, description, and quantity of the goods dispatched to the customer and is signed by the customer to acknowledge receipt of the goods. Devin also writes the delivery note number on the picking slip for reference purposes and sends it back to Daniel, the warehouse clerk, to retain on file in numerical order. Devin records the delivery notes in sequential order in his delivery note register. Devin then sends 2 copies of the delivery note to the customer. When the delivery truck is on the way out of the premises, the driver has to stop at the security gate for security to check the goods on the truck against the delivery note. Security then signs as evidence of the check. When the delivery truck arrives at the customer's premises, the customer checks the goods against the delivery note, signs the delivery note, and keeps a copy for their records. The driver keeps the original delivery note, which has been signed by the customer, and takes it back to the warehouse. At the end of each day, Charles, the warehouse manager, ensures that all the delivery notes have been returned. He sends all the day's delivery notes to the debtors clerk, Martin, in the finance department. Let's look at some examples of objectives, risks, and controls for the dispatch step in this cycle. An example of an objective is to ensure that only the correct authorized goods are dispatched on time and to the correct customers. The risks for this step could include: goods released from the warehouse are never dispatched, which will lead to inventory losses and dissatisfied customers. Goods dispatched for false orders, leading to inventory losses or theft. And the customer denying having received goods and refusing to pay for the goods. Potential controls to implement for these risk examples include: delivery staff, for example the driver, should supervise the loading of the truck and sign a delivery list to acknowledge receipt of the delivery notes and the corresponding goods. Gate controls, for example security, should check that all goods to be delivered appear on the delivery list and are supported by delivery notes. Both copies of each delivery note should be date stamped by gate control. Another control example includes that the customer should, on delivery of goods, sign both copies of the delivery note after having checked the goods. He then retains one copy and returns the other copy with the driver. Remember, these are a few examples, but there are many more objectives, risks, and controls that apply here. Can you identify anything else that can go wrong during this step? Which control would you use for this risk? Step 5 in this cycle is where we generate the invoice for the customer. This takes place in the finance department. Martin, the debtors clerk, matches the ISO to the delivery note. He then enters the quantity and type of goods on the accounting system. The system automatically generates the amount due by using the approved price list, which is loaded on the system. It also automatically calculates the VAT. The system then generates a pre-numbered invoice, which Martin sends to the client. He also prints and files a copy of the invoice. An invoice is a document that is sent to the customer to inform them of the quantity and price of goods purchased, the total amount of the sale, discounts, and VAT. The sales manager, Rob, will review the sales numbers at the end of each month. Have you identified any risks and controls in this step? Let's firstly look at examples of objectives. Examples of objectives include to ensure that all invoices are accurately prepared based on the most updated price list and that it reflects all goods that were dispatched to the customer, and to notify the customer as soon as possible of amounts payable for goods supplied. Risks for this step could include not invoicing goods dispatched, resulting in the payment never being received from the customer, and inaccurate invoices being sent to the customer because they are not based on the most updated price list, or the goods reflected on the invoice are not the goods dispatched to the customer, or the quantities are incorrect. This will result in a delay to collect the payment for the goods, as a new invoice will have to be issued. Potential controls for these risks include the debtor's clerk should review unmatched ISOs on a weekly basis to ensure that there are no long outstanding orders and that all orders are invoiced. All long outstanding ISOs should be followed up. The debtor's clerk should review the invoice generated by the system and ensure that it has been accurately generated by matching it to the ISO and the delivery note. Now that you have a better view on how we generate invoices, let's take a look at step 6, where we record the sale. As soon as the invoice is generated by the system, the accounting system automatically enters the sale into the sales journal and allocates the correct account to be posted to the general ledger and debtor's ledger. For example, if the goods cost 100 Rand and there are no VAT implications, the accounts receivable is debited with 100 Rand and the revenue account is credited with 100 Rand. The sales journal is a record of the business's sales. Martin, the debtor's clerk, follows up on any ISOs on his file which have not been matched to delivery notes and for which invoices have not been created. The financial manager, Susan, does the following. Reviews the sales recorded on a monthly basis to identify any unusual items. Reviews the accounts receivable age analysis on a monthly basis to identify any long outstanding debts. Performs a reconciliation of the customer or debtor's ledger to the customer or debtor's control account in the general ledger, and signs off on the customer ledger and customer control account when satisfied that the transactions and posting to the ledgers are valid, accurate, and complete. Martin will perform a monthly debtors reconciliation. This includes reconciling the accounts receivable information per the accounts receivable module in the accounting system to the general ledger account to ensure that all transactions have been recorded in the general ledger. Martin also draws up statements for each customer or debtor every month. The statement is a summary of all the transactions for a period, usually a month, sent by the company to the customer. Martin then checks that the balances on each statement match what is shown in the customer or debtor's ledger. He then sends a statement of account to each customer or debtor at the end of every month. Next, we will look at the possible objectives, risks, and controls for this step. An objective here is to ensure that all sales are accurately recorded in the accounting system. Risks for this step could include duplication of invoices in the sales journal or invoices not being recorded at all, and entering invoices against the wrong customer or debtor in the debtor's ledger. Potential controls for these risks include invoices must be entered in the sales journal in numerical sequence, and independent staff members should sequence check sales journal entries and follow up on any missing invoices, compare customer name and amount entered in sales journal to the invoice for accuracy, and check postings or transfers from the sales journal to the debtor's ledger for individual debtors. Also check postings from the sales journal to the general ledger. Remember, these are a few examples, but there are many more objectives, risks, and controls that apply here. Can you identify anything else that can go wrong during this step? Which control would you use for this risk? Step 7 is receipt payment, where customers pay their accounts via electronic funds transfer or EFT using their account number as a reference. The customer then sends a remittance advice or proof of payment to the finance department. These remittance advices are entered into the remittance register. A remittance advice is a document sent by the customer with their payment to indicate precisely which invoices will be paid. The bank and cash clerk, Terence, reviews all credits to the bank account by reviewing the bank statement on a daily basis and allocating the payments received to the customer's account. Terence issues receipts for all payments received. The receiving of cash in the revenue and receipt cycle and making payments in the acquisitions and payment cycle make up the bank and cash cycle. Let's discuss possible objectives, risks, and controls for this step. An objective here is to accurately record customer or debtor payments by making out receipts. Risks could include making out receipts to the wrong customers and not making out receipts for payments received. Potential controls for these risks include receipts should frequently be matched to remittance advices from customers, and bank statements should be obtained frequently and compared to receipts. Think about other things that can go wrong in this step. Which controls would you suggest for these risks? Step 8. Recording of receipt happens after all the payments received have been allocated to specific customers. Terence records all the payments for the day in the general ledger based on the daily bank statement. If a receipt cannot be allocated to a specific customer, the receipt will be accounted for in a suspense account until it has been determined who the receipt was from. Your textbook refers to payments made by checks. However, in modern society, this has been replaced by EFT. This limits the risk of fraudulent payment due to theft of blank checks. Please note that the bank reconciliation process at month end is the detective control to identify any inaccurate recordings of money received into the general ledger. Susan, the financial manager, checks the cash receipts journal once a week for accuracy and completeness. She also checks that the receipts journal is recorded in sequence of receipt numbers and has been accurately recorded and posted to the general ledger control account as well as the customer or debtor's ledger. Once she is satisfied that all is in order, she will sign off on these documents. What can you identify that can go wrong during this step? Which controls would you use to prevent these risks from happening? Let's look at a few examples of objectives, risks, and controls that apply here. An objective includes to record receipts accurately and enter these against the correct debtors. Risks for this step could include not recording receipts at all, which will lead to the incorrect reflection of the amount owed, and entering receipts against the wrong customer or debtor. Examples of controls for these risks include managers should review the cash book, also known as the cash receipts and cash payments journal, for missing dates and gaps in sequence of receipts, as well as test postings to the debtor's ledger. And the cash book should be reconciled to the bank statement every month by an employee who is independent of the banking or recording of cash. The bank reconciliation should be reviewed by a senior employee in finance. For step 9, we return to the warehouse where goods are returned to the goods receiving section. Upon return of goods by the customer, the receiving clerk, Joe, will inspect the goods against the delivery note signed by the customer. If the goods match the delivery note, a goods return voucher or GRV is provided to the customer, and a copy of the GRV and delivery note is sent to Charles, the warehouse manager. If the goods returned do not match the delivery note, Charles will inform Rob, the sales manager. Rob will contact the client to follow up on the discrepancy. The goods will not be booked into the store until the differences have been resolved. A credit note is prepared and sent to Charles to check against the GRV and sign off. After Charles authorizes the credit note, he sends the credit note to the finance department for further processing. The returned goods are then transferred to the finished goods store together with a copy of the delivery note and GRV. Bongani, the finished goods store clerk, must check the goods received against the documents provided and sign off that the goods received match the description in the documentation. Can you think of objectives, risks, and controls for this step? Let's take a look at some examples. An objective identified here is to record the return of goods accurately and credit the correct customer's account. Risks for this step could include inaccurate recording of the goods returned on the GRV, resulting in the customer receiving more credit than required, and passing credit notes for goods which have not been returned. Examples of controls for these risks include the goods receiving clerk has to inspect the goods returned to ensure they match the description and quantity on the delivery note. The clerk then has to sign the documents, and a warehouse manager has to authorize the credit note before it is sent to accounting. The last step in this cycle is credit management, which takes us back to the finance department. Peter reviews the debtor's age analysis to identify debtors who have not paid their accounts on time. He contacts outstanding debtors in order for them to make arrangements for payment. Debtors who still do not pay as per agreement are handed over for debt collection. Where it is impossible or too expensive to collect debt, debtors are recommended to be written off as bad debt. Let's look at examples of objectives, risks, and controls for this final step in the revenue and receipt cycle. An objective includes to limit loss from bad debts and encourage debtors to pay on time. Examples of risks here are if debtors pay late or debts are written off unnecessarily. Potential controls for these risks include the following. Credit controllers should contact customers to renegotiate credit terms or inform them of legal action. Debtors should be handed over for debt collection before too long a period has gone by. And debt should only be written off if all the following steps have been taken in sequence. Ensure all the necessary credit management steps were taken without success. Ensure the recommendation of writing off debt is received from a credit controller. And ensure an independent senior financial employee has reviewed the supporting documentation and authorized the debt to be written off. Think about other things that can go wrong in this step. Which controls would you suggest for these risks? To conclude our discussion, the revenue and receipt cycle is the heart of the business, as this is where we exchange our goods with customers for cash. It is also where we collect our money. This is why we focus so much on identifying risks and controls. If we know what our risks are, we can implement controls to prevent unnecessary mistakes, which could lead to a loss of money.
I'm back again. This was a long cycle, but a very important one. I hope you learned a few things. Until next time.